Hello traders. Another mind-blowing concept that will make you profitable. Listen to this, traders.
I cannot stress how important it is to focus on liquidity. Liquidity is everywhere in the markets. It is what drives the markets forwards and backwards. Price is seeking towards levels of liquidity after taking out levels of liquidity. Price will rebalance into areas of inefficient price action in order to target liquidity. If you struggle with liquidity, just think of highs and lows. At every high, there is liquidity, and every low, there is liquidity. When you see price trending, what you're going to notice is price is going to create areas of inefficient price action. Once you see these areas of inefficient price action getting rebalanced into and price starts shifting towards the upside, your target is going to be this high right here, because that is liquidity.
Now, let's break it down, because there is a lot to understand before using this strategy, because I know only a few have understood this. 1. He says, price is seeking towards level of liquidity after taking out levels of liquidity. Wow, I know you can ask yourself, what is he trying to say? Some can say the guy know nothing about forex. Relax, he is talking about external and internal liquidity. I know this sounds new to many traders, and that's why it's important to break this down. Before we dive into this, keep in mind the market moves in cycles, external liquidity to internal liquidity and vice versa. That's why you need to stick here and learn something from this video. Before I continue, if you love my contents, kindly subscribe to this channel, like and share, and as well, leave a comment and your thoughts. Now, allow me to talk about liquidity and internal and external range liquidity, because it's the backbone of this trading strategy. Let's first of all start by understanding liquidity in forex. So, what is liquidity in forex? Liquidity zones in the forex market are areas where there is a high demand to buy or sell a specific currency pair. These zones are critical for traders as they provide insights into potential market trends and price movements. Identifying these zones involves combining volume analysis with the identification of support and resistance levels. External and internal liquidity in forex. Before delving into external and internal liquidity, let's cover some basic concepts to make the discussion easier to understand. Why do prices move? Prices in the forex market move for two primary reasons. 1. To sweep liquidity. 2. To balance the fair value gap, FVG. With that, let's understand ICT dealing range. What is ICT dealing range? The ICT dealing range is defined as the area between an established swing high, which has taken the liquidity of a previous high, and an established swing low, which has taken the liquidity of a previous low. So, what is internal range liquidity? Internal range liquidity refers to the liquidity within the defined dealing range. This can be identified by various institutional reference points such as order blocks, fair value gaps, and volume imbalances. However, within the ICT framework, only the fair value gap is specifically marked as internal range liquidity. This is because a fair value gap is formed by three candles, where the high and low of the first and third candles do not overlap, creating a liquidity level in lower time frames. When prices move to balance the fair value gap, they sweep the liquidity in lower time frames, which is why the fair value gap is considered ICT internal range liquidity. We are done with internal range liquidity. So, what is external range liquidity? External range liquidity is the liquidity found at the previous highs and lows of an ICT dealing range. This can include stops or pending orders. In this context, the high of an ICT dealing range is termed buy-side liquidity, as it is assumed that buy stops rest above this level. The low of an ICT dealing range is termed sell-side liquidity, as it is assumed that sell stops rest below this level. So how do you identify external and internal range liquidity? To identify these liquidity ranges, follow these steps. 1. Define the range using swing highs and lows to mark the beginning and end. 2. Choose the recent trading range relative to your specific time frame. How do price move to take liquidity? Prices typically move in a cycle, from external to internal liquidity, then from internal to external liquidity. After taking external range liquidity, prices move toward internal range liquidity to balance the fair value gap, then move back toward external range liquidity. Daily bias identification using ICT ERL and IRL. The concepts of ICT internal range liquidity, IRL, and ICT external range liquidity, ERL, can help in identifying the daily market bias. Steps to identify daily bias. 1. Identify IRL and ERL on daily/weekly charts near the current market price. 2. Determine potential bias based on the liquidity levels. If the price first takes internal range liquidity and external range liquidity is above, the bias is bullish. If the price first takes internal range liquidity and external range liquidity is below, the bias is bearish. Scenarios after taking ERL. 1. In bullish market, if price sweeps and closes below ERL, old high, with reversal/momentum shift in lower timeframe. This is a sign of potential bearish reversal. The market may now go down to take the untouched IRL, fair value gap, below. 2. Price closes above the ERL while there is no reversal/momentum shift after reaching ERL, old high. There can be two possibilities. 1. Continuation of bullish trend. The market may continue its upward movement beyond the ERL. 2. Consolidation. The market may consolidate around the ERL level before making another directional move. Important considerations. This method assumes the market tends to fill liquidity gaps and balance imbalances. It is crucial to use other technical indicators and consider the market context for confirmation before making trading decisions. Backtesting and paper trading are recommended to evaluate the effectiveness of this method under different market conditions. Conclusion. Understanding and identifying liquidity zones, internal and external liquidity, and the movement of prices between these zones can significantly enhance trading strategies. This method, when combined with other technical analysis tools, can provide a robust framework for making informed trading decisions. Thanks for watching this video. Let me hope it was helpful. I will see you in my next video. Listen traders, before you make any big mistake, like paying for that expensive course, try reading this book first. This is basically what you are going to be taught by your mentor. In fact, not even everything. If you are a beginner and you have learnt only basics, don't dare funding your forex account because you will not like the results. This book will introduce you to another side of forex trading because you cannot like forever buy at support and sell at resistance. This book comprises of everything you need to know about smart money concepts and price action, and everything is explained simply. Grab your copy at $10 only and it will save you from a lot rather than paying for
Now,
those so-called
if you want to kick off your
forex journey, WhatsApp this number to order your copy. First come, first serve.